Hello, my name is Sashan.
And my name is Zishan, and this is our stock pitch analysis on Woodward Incorporated. Woodward is a mid-cap company that produces control services for aerospace and industrial markets. For its revenue, aerospace accounts for 61% of its total revenue stream, and industrial accounts for 31%. The focus of Woodward is to increase the efficiency of these applications for its buyers so that there's greater functionality and sustainability in the products.
We rate Woodward as a strong buy due to the growing aerospace demand, the future of the industrial segment, and the strategic relationships with Woodward possesses. Aerospace demand has grown at a CAGR of 20% and is predicted to do the same thing for the next 3 years. Woodward creates important products for the aerospace industry, specifically for airlines. We can go see in that for the image on the left. Reverser actualization systems, oil management, cockpit controls, all of these are important for modern day aircraft. As modern day aircraft expand, Woodward will see increased profitability as its products will be used in more flagship aircraft. Furthermore, with the growth of AI, Woodward is seen as an indirect beneficiary, as it services a bunch of data centers and power centers. Furthermore, transportation and oil and gas markets are also predicted to rise in the future. Lastly, Woodward holds specific and closely knit strong relationship with key original equipment manufacturers or OEMs. As these OEMs look to expand, so will Woodward. We started our research on January 2nd, 2025. The price then was $171.24. Since then, it's grown 11% to its current price of $190.24. Our target price is $228.77, a 33.6% uprise from the January 2nd price. Over the past year, Woodward has grown at a CAGR of 21.73%. This is 3x the S&P 500 and twice as big and almost 4 times as big as the aerospace and industrial apparatus market and is much greater than the industrial apparatus market. Furthermore, Woodward is extremely undervalued compared to its competitors. It has a PE to E ratio of 30.7x compared to the industry's 89.27.
Now let's take a look at the competitive positioning of Woodward. Two of its largest competitors are Honeywell Aerospace, Moog, and Eaton. Relatively, Woodward has a faster growth rate and it has stronger strategic relationships with some of the largest buyers. That's going to allow Woodward to position himself and outperform these competitors. Now, as we can see in the Porter's Five Forces chart on the right, we see that there's very low substitutes or threat of new entrants. And this is because of one, the high fixed costs required to enter the industry, and two, this is what Woodward is doing so well on, it's capitalizing on the strategic positioning with the industry leaders that has already formed partnerships. So
These are some of the biggest companies in the industries. Lockheed Martin, Raytheon, Caterpillar, General Electric, Airbus, Boeing. All of these are huge companies in the aerospace and industrial fields. All of these companies are also directly serviced by Woodward's and its products. Furthermore, Woodward services companies which are also its competitors, mainly Honeywell Aerospace and Eaton. This goes to show that the entire aerospace and industrial industries are built on Woodward's products, meaning that as these industries grow, so will Woodward. This is seen through competitive positioning. Woodward has a return on equity percentage of 16.72. This is the second highest amongst its competitors. Furthermore, it dishes out dividends at a 14% greater rate compared to its competitors. And these statistics show that Woodward is just genuinely more attractive towards investors as it cares more about them. Let's talk about some revenue drivers. The biggest revenue driver is the aerospace field. Airbus and Boeing are two of the biggest OEMs in the aerospace division. And these companies have backlogs. They're unable to distribute aircraft at a good rate. We calculated that Woodward will generate approximately $4.3 billion in future revenue from backlogs. However, as these backlogs expand, airlines will have to use older legacy aircraft, which allows Woodward's MRO sector for the aerospace division to capitalize, generating approximately $4.06 billion in MRO sales.
now, going into more details for its future growth, Woodward has the potential to gain $2.79 billion from its MRO for transportation, oil, and gas, an additional $8.63 billion for its aerospace division. This is calculated based on the current growth rates, and this is projected for the next 3 to 5 years. In this case, Woodward has the potential to increase its market cap by over 100%. Now, moving on to investment risks, one factor to consider is the cyclicality of segments for Woodward. This means that Woodward earns more profit in some parts of the year compared to others. However, we need to consider that this is not a deterministic factor that's obstructing its growth. Across the financial charts, we see that Woodward is still experiencing high growth as well as high increases in revenue and return on margins. Another factor for the investment risk is its over-reliance on key OEMs. For the OEMs, however, they are OEMs that's, again, as stated before, positioned itself as leaders across the industry. What this allows for is that these companies are essentially too big to fail, and as these companies continues to expand, this is going to cause greater demand, and this is in turn going to create greater profit for Woodward. Lastly, another risk is competition. As stated before, the strategic partnerships Woodward has formed with these companies is going to help them outperform its competition.
Let's get into some financial analysis. Woodward has seen a 13.1% growth in revenue within the past 4 years. This marks a gross profit high of $876 million in 2024. And this is reflected through their earnings per share growth from 3.86 to 6.21. Normally, as investors, we want to capture companies as they are starting to revamp their business, which is approximately what Woodward is currently doing. Furthermore, total assets are twice as big as total liabilities, and this is reflected in the operational cash flow growing 48% to $439 million for 2024. This allows Woodward to dish out dividends, which it has been consistently doing since 2021, growing its dividend year rate quarter over quarter.
We conducted a discounted cash flow analysis of Woodward for a bearish case, a base case, and a bull case. In all three of these cases, Woodward outperforms the S&P 500, and this is taken for different adjustments in variables. Now, moving on to the impacts of AI. What we need to recognize is that Woodward is an indirect beneficiary of AI. As AI continues to grow, there's going to be a greater demand for data centers. And as the data centers grow, this is where it feeds greater opportunities for Woodward, because Woodward provides the control systems that allows the AI data centers to operate. Internally, artificial intelligence allows Woodward to further increase its efficiency for the products. It allows Woodward, as it increases the efficiency for the products, to increase its ESG rating. And overall, AI allows Woodward to increase the production process and lower the production costs associated with it, with more optimization. Lastly, let's talk about ESG ratings. Woodward currently has a ESG rating of 60, and this is above the industry average. Environmentally, Woodward helps contribute towards the transition for cleaner energy as it allows in its hydrogen-powered innovations. Socially, Woodward has launched programs to help fight for employee benefits and has a strong historical record with governments. Now, corporate governance, Woodward has one of the highest rankings in the industry, and it fights anti-corruption policies with different programs that it's doing.
Overall, we rate Woodward as a strong buy to hold for the next 12 months. Thank you and have a great day.
Yeah.